Hi, Catherine Smith here from Holistic Financial Solutions. Today we're here to have a quick look at how to buy properties in companies, trusts and super funds, which is best and why. So it's presented by myself, Catherine Smith. I've been in the industry over 20 years and have various qualifications in financial fields including taxation, property, real estate, superannuation and a few more. Most of all, I've been a passionate property investor for over 20 years, buying my first property at the age of 17 and having bought and sold numerous properties since then. So how to buy a property? The very simplest way is in your own name, as an individual, joint or tenants in common. You can also buy in a company name with you or others as directors. You can buy in the name of a self-managed super fund with you, others, your partner, children as members of the fund. You can also buy in the name of a trust. There's several different types of trust: discretionary, unit and hybrid. It's all very confusing. Today hopefully we're going to clear up a bit of the confusion and have a look at how to buy property. So in individual names, as I mentioned, it's the simplest possible structure. But you've got no asset protection in the case of relationship breakdown, creditors, lawsuits. It's okay for those who are 100% sure none of these things will ever happen to them. But for others, let's have a look at some other strategies. If you do buy in your own name, one way of protecting the asset is to ensure it is geared to the maximum possible extent. That is, borrow as much as you can for the property so there's less equity for anyone to sue you for. Buying a company, it has a few benefits, but it's not recommended under any circumstances at all. There's very bad capital gains tax consequences. I haven't got time to go into them, so I'll simply say it is definitely not recommended. In a self-managed super fund, I have a whole webinar on this topic, so please have a look at that. But very quickly, there's a maximum of 15% tax, asset protection from creditors, 10% tax on capital gains, but the best incentive of all, if you hold those properties until the age 60 and commence a pension, any capital gain on the property will be entirely tax-free. Any rent on the property will be entirely tax-free. Any income paid out to you will also be entirely tax-free. Self-managed super fund, in my opinion, is one of the best ways, or is the best way to buy property. However, it's not applicable for all if you don't have enough in your super for a deposit yet. So view my other YouTube video on this topic. In a trust, well, what is a trust? Basically, it's a promise or agreement, evidenced in writing, which is called the trust deed, between a person who agrees to hold the property on behalf of someone else, the beneficiary. No one size fits all. There's discretionary, unit and hybrid trusts, and they all have vastly different consequences. So do get professional advice. Let's have a look at a real-life example of a trust. This is a discretionary trust. The trustee company controls the trust. The trust owns the property. The trustee has discretion as to who gets what each year. And it can be varied every year. So discretionary trusts have very good tax planning benefits. There's also no fixed ownership. Nobody actually owns a fixed proportion because it can change every year. So it's good for asset protection. This is a very simple structure and very good for families. You can also add new beneficiaries at any time if more children arrive or some of the siblings get married. So in this example, the trust buys the property and the bank takes a mortgage over the property. All beneficiaries will still have to guarantee the loan. So that's very simple. So what are the benefits? They're not necessarily good for property because you lose the negative gearing benefits. So people on a high income that are buying a negatively geared property are probably best off not using a discretionary trust. There's land tax issues in some states. It can be harder to obtain finance. But it is good for cash flow properties, except in New South Wales. And it's only really good for cash flow positive portfolios, and once again, not in New South Wales. So once again, as you can see, there are so many different options here depending on where you're buying, whether you're buying negatively geared or positively geared. So discretionary trusts are good for families and great for asset protection, but they do have some negative effects as well. So it's good to seek professional advice. A unit trust, on the other hand, is a different type of trust where, in this example, Mr. A, B, Mrs. B and Mr. C actually do own a fixed percentage. The trustee controls the company, trustee company controls the trust, and the trust owns the property, same as a discretionary trust. The unit holders are beneficiaries, and the income is distributed in a fixed entitlement every year. What that means is there's less asset protection because you actually own a fixed unit that somebody can sue you for, and it can't be varied each year, so the tax planning isn't as good. You can add new unit holders. This is better for properties where they're non-related parties. So the discretionary trust can be used for families and a unit trust for non-related parties, such as friends, partners, etc. So this is a real-life example. The trust buys the property again and the bank takes the mortgage. So why do this? The bank lends to the unit holder, to Mr. A. Mr. A lends that on to the trust to buy the property. Mr. A guarantees the loan and the bank takes the mortgage in the normal way. What this means and why unit trusts differ from discretionary trusts is that you can use the negative gearing benefits by using a unit trust. But there are some cons. It's a little bit harder to get a bank loan. There are more accounting fees. So once again, get professional advice. So let's weigh up your options with a unit trust. It's best for non-related arm's-length investors. It does allow for units to be transferred easily. It's quite easy to understand. And you have the company as trustee to ensure limited liability. It may allow negative gearing benefits if it's structured correctly. The disadvantage is that the fixed distributions cannot vary from year to year, and the asset protection is not as good. So once again, weighing up your options. As an individual, very simple, but no asset protection, so be careful. Company, just not recommended. Self-managed super fund, as I said, absolutely fantastic option for those that can lock the money away till 60, but do get advice. Trusts, the recommended structure, but which type? So consider all your options and get advice, and do it before you find a property. In fact, do it before you even start looking so that you can get this set up right from the beginning. So in summary, there's many different options. All have pros and cons. There's no one size that fits all. Get advice before you even start looking to buy a property or set up a business for that matter. Get your structure right first. Get the foundations right before you try and build from there. So set up the structure. As you say, would you buy a property that doesn't have a proper plan and structure and foundations? No, you wouldn't. Your investment journey involves setting up the structure, preparing a plan, then applying for the finance and then finding the property, not the other way around. So many people find the property and then start wondering what they should do. So the most important part of every business venture or property plan is to get the foundations right in the first place. Research your options, get advice, get it right before you begin, because those who fail to plan to fail. So luck is what happens when preparation meets opportunity. Here you have opportunity, and I wish you all the best of good luck. Know where you're going. There's no hope of success for the person who does not have a central purpose or a definite goal. Have you ever wondered how many properties you can buy, how much you can borrow, how much it will cost you per week, how you should structure the purchase for tax purposes? We offer a property portfolio review for $385, which includes an hour consultation and discussion about your plans. If you're interested, email myself, catherine@wfscanberra.com.au. You can also download our free report, which talks about how to build a property portfolio the right way, and the 7 elements to building a successful property portfolio. That can be downloaded from www.wfscanberra.com.au. www.wfscanberra.com.au. So where to from here? Determine your strategy. Come in for a free appointment with us just to see what we can do for you. Download our free report, watch our other YouTube videos, or contact myself for further information.